There is a secret language in the world of finance, a hidden rhythm understood by only a select few. It's not a language of complex algorithms or insider information. It's the language of cash. Not profit, not revenue, not the headline numbers that flash across your screen, but the simple, brutal, life-giving flow of actual money. Most investors, even seasoned professionals, are deaf to this language. They read the sheet music, the income statements, and the press releases, but they cannot hear the song. Warren Buffett, however, is a virtuoso. He hears the symphony in the silence, the powerful current running beneath the surface of a balance sheet. And the most beautiful melody he ever discovered, the one that became the foundational secret to the entire Berkshire Hathaway empire, is a concept so powerful and yet so simple, it seems to defy financial gravity. It is the principle of the magical business, the corporate unicorn that has discovered how to grow without needing any cash. In fact, it's a business that gets its customers and its suppliers to give it an ever-increasing pile of money to play with, for free, forever. This isn't a fantasy. It is the power of negative working capital. And understanding it is the final promise of financial clarity, the key that separates the 99% who trade stocks from the 1% who build empires. To ignore this principle is to invest with a blindfold on, constantly vulnerable to the costly market mistake that traps millions. Pouring your hard-earned capital into businesses that look like they're growing, but are in fact financial black holes, forced to tie up huge, ever-increasing amounts of cash in inventory and receivables, a constant, unforgiving anchor dragging against their potential. But today, that changes. Today, you will learn to see the world through the oracle's eyes. You will gain the financial transformation that allows you to identify these rare, wonderful businesses. The ones funded by everyone else. The ones that allow you to stop betting on growth and start owning the engine of it. This is not just another piece of investing advice. This is the blueprint for a different class of wealth creation. The story of how this powerful idea took root in Warren Buffett's mind doesn't begin in a bustling Wall Street boardroom or a sophisticated stock analysis seminar. It begins in the decidedly unglamorous world of property and casualty insurance in Omaha, Nebraska. It's 1967. The world is a whirlwind of change. The summer of love is in full swing. The space race is at its peak, and the stock market is a playground for gunslingers chasing the hot new thing. In this environment, a small, struggling textile mill from New Bedford, Massachusetts, called Berkshire Hathaway, run by a 36-year-old Warren Buffett, makes a move that baffles the financial community. For a mere $8.6 million, Berkshire acquires National Indemnity Company and its sister company, National Fire and Marine Insurance Company. To the outside world, this was an odd, almost nonsensical diversification. Why would a dying textile business buy a boring, regional insurance company? It was like a horse and buggy manufacturer buying a railroad. But Buffett wasn't buying an insurance company, he was buying a cash machine. He had discovered a concept he would later call the float. Imagine you buy car insurance. You pay your premium, let's say $1,000 for the year. On January 1st, your insurance company now has your $1,000. But you, hopefully, will not have an accident that day. You might not have one for months or years or ever. In the time between when the insurance company receives your cash and when they might have to pay out a claim, they get to hold your money. Now, multiply that by millions of customers. The result is a colossal, ever-replenishing pool of cash, premiums collected, that have not yet been paid out in claims. This pool of money is the float. On a balance sheet, it's technically a liability. It's money the company owes to its policyholders for future claims. But in practice, it functions as a massive, interest-free loan. More than interest-free, actually. If the insurance company is well run and prices its policies correctly, a skill known as underwriting, the premiums it collects will be greater than the claims and expenses it eventually pays out. This results in an underwriting profit. In that scenario, the company is not just getting an interest-free loan, it is literally being paid to hold and invest other people's money. This was the revelation that struck Buffett with the force of a lightning bolt. When he looked at National Indemnity, he didn't just see a company selling insurance policies. He saw a business that collected cash up front and paid its bills. The claims, much later. While other businesses had to beg banks for loans or dilute their shareholders by issuing new stock to get capital for growth, National Indemnity's very operations generated the capital for them. The more policies they wrote, the bigger the float grew. The bigger the float, the more money Buffett had to deploy into his other passion, buying stocks and entire businesses. He could take this float, this gigantic pile of someone else's cash that cost him nothing, and invest it in other wonderful businesses like Coca-Cola or the Washington Post, reaping all the rewards for Berkshire's shareholders. He had found a business that was funded by its customers. It was the financial equivalent of alchemy. He wasn't just investing in the stock market. He was investing with the stock market's money. This single purchase in 1967 for $8.6 million transformed Berkshire Hathaway. The float from its insurance operations grew from just a few tens of millions to over $140 billion today. That $140 billion is not a bank loan. It's not shareholder capital. It is a permanent, self-replenishing mountain of capital that has funded the acquisition of dozens of companies and built one of the greatest financial fortresses in human history. The initial purchase of a boring insurance company was the key that unlocked a kingdom. It was the foundational anecdote, the first and most powerful example of a business with a negative working capital cycle. The psychological principle that allowed Buffett to see this opportunity where others saw only complexity and boredom is a profound one. It's about overcoming our brain's inherent action bias and its preference for the tangible over the intangible. Most investors feel the need to do something. They buy, they sell, they trade, they react to news. The idea of owning a business that simply sits there, collecting cash and patiently waiting for opportunities, seems passive and unexciting. It doesn't provide the dopamine hit of a stock skyrocketing on a hot tip. Buffett, however, understood the immense power of profitable patience. He saw that the true action was happening beneath the surface, as the float silently accumulated, day after day, providing the fuel for future growth. He was playing a different game, a longer game. Furthermore, the human brain is wired to value what it can see and touch. A factory, a fleet of trucks, a shiny new headquarters, these are tangible assets that feel real and valuable. An insurance float, on the other hand, is an abstract concept. It's a liability on a balance sheet. It's a promise. Most people's minds glide right over it, unable to grasp its profound economic substance. They are susceptible to what psychologists call attribute substitution, replacing the complex, important question of how does this business generate and use cash, with the simpler, more tangible question of what does this company make or sell. Buffett's genius was in his ability to see the invisible economic reality. He saw the float not as a liability but as a non-interest-bearing, long-duration asset that could be invested for Berkshire's benefit. This ability to prioritize the abstract economic engine over the tangible physical assets is a hallmark of a CEO mindset, a way of thinking that separates true capital allocators from mere managers. So how can we translate this into a practical blueprint, a mental model for our own investing and business analysis? We can call it the Float Finder's Blueprint, and it goes beyond just insurance companies. Step 1 is to fundamentally shift your perspective when you look at a business. Don't ask what does it sell first, ask when does it get paid. This is the master question. You are hunting for businesses that receive cash from their customers before they have to pay for the costs of delivering the product or service. Step 2 is to identify the source and cost of this float. In insurance, the float comes from premiums, and the cost is the future claims. A well-run insurer keeps that cost below 100% of the premiums, achieving an underwriting profit. In other industries, it might look different. A magazine publisher collects subscription fees upfront for a year's worth of magazines they will print and mail over the next 12 months. That subscription money is their float. A concert promoter sells tickets months in advance for a show. That ticket revenue is their float. The key is to ensure the cost of holding this float is zero or negative. The magazine must be able to produce its issues for less than the subscription price. The concert must be profitable after paying the artists and the venue. Step 3 is the most important part of this mental model. Analyze what management does with the float. Are they treating it like the precious free resource it is? A great management team, a team with a true CEO mindset for capital allocation, will take that float and reinvest it in high-return opportunities, either within the business or by acquiring other assets. A poor management team will squander it on wasteful projects, overpriced acquisitions, or simply let it sit in a low-interest bank account. The presence of a float is the opportunity. The intelligent use of it is what creates the magic of compounding. This framework is a powerful tool for stock analysis, shifting your focus from the noisy income statement to the bedrock reality of the cash flow statement. To truly appreciate the power of this approach, we must examine its antithesis, the path of the 99%. Most investors do the exact opposite. They are drawn to stories, not cash flows. They hear about a revolutionary new technology or a hot retail brand, and they get excited. They see revenue growth, and they pile in, completely blind to the underlying economics. They see an insurance company, and they think, boring, complicated black box. They see a fast-growing tech company, and they think, exciting, innovative, the future. They fail to ask the crucial question, where is the cash to fund this growth coming from? They completely ignore the concept of float because it's not part of the exciting story. Instead, they focus on metrics that are easily manipulated, like earnings per share, or vanity metrics like user growth. They'll buy a company that's growing sales at 50% per year, not realizing that for every new dollar of sales, the company has to spend $1.20 on new inventory, new factories, and extending credit to its new customers. They are buying a business that is literally growing itself into bankruptcy. This path is paved with popular, well-known companies that looked like winners but were built on a foundation of financial quicksand. They are seduced by the sizzle and never bother to check the stake. By ignoring the fundamental language of cash and the concept of float, they are willingly choosing to play a harder, more dangerous game. They are investing in businesses that consume cash rather than produce it as a byproduct of their very operations. It is a recipe for subpar returns and, in many cases, catastrophic losses. The direct financial connection between Buffett's discovery and Berkshire Hathaway's legendary success story is the most compelling proof of this principle's power. It's written in the numbers, year after year, decade after decade. The insurance float is a liability on Berkshire's balance sheet, listed under liabilities and shareholders' equity. But its effect is felt on the asset side and through the income statement. That massive pool of capital, which has grown from millions to over $140 billion, is invested in a sprawling portfolio of stocks, bonds, and wholly owned companies. The income from these investments, dividends from Coca-Cola, profits from BNSF Railway, interest from Treasury bills, flows directly to Berkshire's bottom line. This investment income has historically far outpaced the cost of the float itself. For many years, Berkshire's insurance operations have achieved a combined ratio under 100, meaning they are running at an underwriting profit. So the direct financial impact is twofold. First, they have a massive, long-term source of investment capital that costs them less than nothing. No bank can offer these terms. No bond market can match it. It is a structural, competitive advantage baked into the very core of the business model. Second, this allows for a rate of compounding that is simply impossible for a normal company. A regular business has to fund its growth with its own after-tax profits, by taking on expensive debt, or by diluting its owners. Berkshire can use its own profits and times the massive, cost-free float provided by its insurance customers. This creates a double-barreled engine of wealth creation. This is how a struggling textile mill in Massachusetts became a $500 billion fortress of American capitalism. It wasn't magic. It was the simple, profound financial connection between collecting cash now and paying bills later. It was the discovery of the float. While the concept of float in the insurance industry provides the most dramatic and foundational example of a business funding its own growth, it is merely one manifestation of a more universal principle. To truly master this idea and apply it across the entire market, we must move from the specific anecdote to the general formula. We need a diagnostic tool, a financial X-ray, that allows us to look inside any company, in any industry, and measure the efficiency of its cash engine. This tool is known as the cash conversion cycle, or CCC. It is the single most important metric that the vast majority of investors have never heard of, and it is the key to decoding a company's true financial health. The cash conversion cycle measures the length of time, in days, that it takes for a company to convert its investments in inventory and other resources into cash from sales. Think of it as the financial metabolism of a business. A fast, efficient metabolism means health and vitality. A slow, sluggish one points to sickness and decay. Understanding this cycle is the difference between being a passive stock picker and a shrewd business analyst capable of world-class financial statement analysis. To illustrate this, let's step away from the abstract and look at two distinct business models. First, consider a high-end, bespoke furniture manufacturer. Let's call it Oak and Iron. Their process begins by purchasing large, expensive slabs of premium walnut wood. They have to pay their supplier for this wood, let's say, within 30 days. That's cash going out the door. Then, their highly skilled artisans spend the next 60 days crafting a beautiful dining table. During this time, Oak and Iron is paying salaries, electricity, and rent, more cash going out. Once the table is finished, it might sit in their showroom for another 30 days before a customer buys it. That entire 90-day period from raw wood to finished product is time their cash is tied up in inventory. But it gets worse. Let's say the table is sold to an interior design firm, which demands to be invoiced and given 60 days to pay. So, from the moment Oak and Iron bought the raw wood, a total of 180 days could pass before they see a single dollar of cash from the final sale. They have funded the entire process, the materials, the labor, the overhead, for 6 months out of their own pocket. This is a business with a long and punishingly positive cash conversion cycle. It is a capital-hungry beast. Now, let's contrast this with the business model that made Michael Dell a billionaire. In the early days of Dell Computers, they pioneered a direct-to-consumer model that was a work of financial genius. A customer would go online, or call Dell, configure their ideal computer, and pay for it right then and there with a credit card. Dell received the cash instantly. At that point, Dell didn't even have the computer parts in their factory. Only after securing the customer's money did Dell's hyper-efficient supply chain whir into action. They would order the specific processor from Intel, the hard drive from Seagate, and the memory from Micron. And because Dell was such a massive, important customer, they had negotiated incredible terms with their suppliers. They might have had 60 or even 90 days to pay those suppliers. Do you see the magic? Dell would often receive the customer's cash, use it to pay their suppliers for the parts, build and ship the computer, and still have leftover cash to use for 30 to 60 days before their bills were even due. Their customers and suppliers were funding their entire operation. This is a business with a negative cash conversion cycle. Instead of needing cash to grow, growth times generated times cash. Every new computer sold didn't just bring in a profit. It brought in a fresh injection of interest-free capital that could be used to fund the next sale, R&D, or marketing. Oak and Iron was constantly starved for cash, while Dell was swimming in it. This is the difference between pushing a boulder uphill and rolling it downhill. The psychological trap that prevents investors from seeing this crucial difference is a cognitive bias known as cognitive tunneling, or more simply, focusing on the wrong thing. When we look at a company, our brains crave a simple story and a simple metric. For many, that metric is revenue growth. We see a company like our hypothetical Oak and Iron announcing that sales are up 30% year over year, and we think, wow, this is a great growth company. We tunnel our vision onto that one metric. We see the rising top line, and we instinctively assume the business is healthy and thriving. This is a classic case of attribute substitution. We substitute the easy-to-understand attribute of sales growth for the more complex but far more important attribute of cash flow efficiency. We fail to ask the second-order questions. How much cash did it cost to get that growth? How much money is tied up in those unsold tables in the showroom? How long will it take to collect the cash from those sales? The income statement can tell a beautiful story of rising profits, but the cash flow statement tells the truth. A company can be wildly profitable on paper and go bankrupt because it ran out of cash. Cognitive tunneling prevents the average investor from looking beyond the headlines and digging into the mechanical reality of the business. They see the scoreboard but have no idea how the game is actually played. Overcoming this bias requires a conscious, deliberate shift in analytical focus, a commitment to understanding the plumbing of a business, not just the paint job. This brings us to the applied mental model, the specific blueprint for performing a cash conversion cycle analysis. This is a skill that will immediately elevate your stock analysis from the amateur to the professional level. The formula itself is simple. CCC equals DO plus DSO minus DPO. Let's break that down. DIO is Days Inventory Outstanding. It measures the average number of days it takes for a company to turn its inventory into sales. A lower number is better. DSO is Days Sales Outstanding. It measures the average number of days it takes for a company to collect the cash after a sale has been made. Again, a lower number is better. DPO is Days Payables Outstanding. It measures the average number of days it takes for a company to pay its own suppliers. From the company's perspective, a higher number here is better, as it means they get to hold onto their cash for longer. So the blueprint is a four-step process. Step 1. Locate a company's financial statements, the annual report, 10K, or quarterly report, 10Q. Step 2. Calculate or find the three key components. You can calculate them using formulas involving cost of goods, sold, revenue, inventory, accounts receivable, and accounts payable, or you can use a financial data service that often provides them pre-calculated. Step 3. Plug them into the formula. CCC equals DIO plus DSO DPO. Let's say a company has 60 days of inventory, collects from customers in 45 days, and pays its suppliers in 75 days. Its CCC would be 60 plus 45 minus 75, which equals 30 days. This means for 30 days, the company has to fund its operations from its own pocket. Now imagine a different company. 10 days of inventory, collects from customers instantly, so 0 DSO like a supermarket, and pays its suppliers in 45 days. Its CCC would be 10 plus 0 minus 45, which equals negative 35 days. For 35 days, this company is using its suppliers' money as a free operating loan. Step 4, and this is crucial for developing a true CEO mindset, is to analyze the trend. Don't just look at a single number. Is the company's CCC getting longer or shorter over time? A shortening CCC is a powerful sign of increasing operational efficiency and a strengthening competitive position. This simple four-step process is a repeatable, reliable way to peer into the financial heart of any business and see if it's a cash furnace or a cash fountain. Now let's explore the antithesis, the path of the 99% who remain blissfully ignorant of these mechanics. The average investor operates almost exclusively on the income statement. They look at revenue, they look at net income, and they think they've done their due diligence. They believe that profit is the same as cash. This is one of the most dangerous and widespread misconceptions in all of finance. A company can report $1 billion in profit but have no cash in the bank if all of its sales are on credit and its customers aren't paying. The path of the 99% involves falling in love with companies that are perpetually in need of more cash. They buy stock in businesses that are constantly raising money through debt offerings or, even worse, secondary stock offerings. A secondary offering is when a company creates and sells new shares, which dilutes the ownership stake of every existing shareholder. If you own 1% of a company with 100 million shares, and they issue another 100 million shares to raise cash, your ownership stake is instantly cut in half to 0.5%. Your slice of the pie just got smaller. Why do companies do this? Often, it's because their cash conversion cycle is so long and their business so capital-intensive that they cannot fund their own growth. They are on a treadmill, running faster and faster just to stay in the same place, and they are using their shareholders' potential wealth to fuel the run. The average investor, focused on the story and the reported profits, sees these capital raises as investments in growth rather than what they often are: desperate life support for a broken business model. This is how you end up with a portfolio of companies that seem to be growing, but your actual net worth goes nowhere. The direct financial connection of the cash conversion cycle is stark and unforgiving. It manifests directly on the balance sheet in the section called working capital. Working capital is broadly defined as current assets minus current liabilities. A business with a long, positive CCC will show large and growing numbers in the inventory and accounts receivable lines on the asset side of its balance sheet. This is the cash that is trapped, the money that is not working for the shareholder. It's dead money, sitting on shelves or waiting to be collected. To fund this trapped cash, the company will have to show a corresponding increase on the other side of the balance sheet, either in debt or by having a lower cash and cash equivalents balance. Conversely, a business with a beautiful negative CCC has the opposite situation. It might have a large liability on its balance sheet called accounts payable, representing the money it owes to its suppliers. But this is a wonderful liability. It's an interest-free loan from suppliers that is funding the business's operations. This structure frees up enormous amounts of cash, which then appears in the cash and cash equivalents line. This is free cash flow, the lifeblood of any great business and the ultimate source of all shareholder value. This cash can then be used for a multitude of wealth-creating activities: paying dividends, buying back shares, the opposite of dilution, investing in new high-return projects, or making strategic acquisitions. A negative cash conversion cycle is a direct pipeline from a company's operations to its shareholders' pockets. It is the quantifiable, undeniable evidence of a business that has achieved capital efficiency, a business that is not just growing, but growing smarter. Once you have absorbed the power of float from the insurance world and mastered the technical tool of the cash conversion cycle, the next logical step is to go hunting. The world is full of publicly traded companies, but these capital-light, negative working capital businesses are the rarest and most valuable of species. They are the unicorns of the financial kingdom. Finding them requires more than just a stock screener. It requires a specific mindset, an ability to recognize the patterns of capital efficiency in the wild. You must learn to look at industries and business models through this new lens, filtering out the capital-hungry dinosaurs and focusing on the nimble, cash-generating mammals. This hunt is the practical application of everything we've learned, transforming theory into a tangible stock-picking strategy that can fundamentally alter the trajectory of your portfolio growth. The perfect foundational anecdote for this hunt is Warren Buffett's 1972 acquisition of See's Candies. On the surface, it seemed like another boring, low-tech purchase, much like National Indemnity. See's was a family-owned box chocolate company based in California. There was no proprietary technology, no patent protection, no explosive growth story. But Buffett and his partner Charlie Munger saw something others missed. They saw a business with a magnificent negative working capital cycle. Think about the business model. See's sells most of its chocolate during two peak seasons, Christmas and Easter. Leading up to these holidays, customers flood into their stores and pay for their boxes of chocolates with cash, right there at the counter. See's collects millions upon millions of dollars in cash before the holidays even arrive. This cash sits in See's bank account. But when does See's have to pay its own bills? The bills for sugar, chocolate, nuts, packaging, and even the seasonal employees. Wages often aren't due until weeks or even a month or two after and off the holiday rush. For a significant portion of the year, See's was sitting on a mountain of cash that was effectively an interest-free loan from its customers. Buffett purchased the company for $25 million. At the time, it was earning about $2 million a year after tax. What happened next is the stuff of legend. Because the business required virtually no new capital to grow, a new store was inexpensive to open and was immediately cash generative. Almost all of the profit it produced could be sent directly to Omaha. Over the decades, that little $25 million investment has generated over $2 billion in free cash flow for Berkshire Hathaway, cash that Buffett then used to buy other assets. See's Candies was a tiny engine of capital generation that helped fuel a massive empire. It was the perfect real-world example of a non-insurance business that exhibited the same magical financial characteristics. The psychological principle that enables an investor to spot a See's Candies while others see only a simple chocolate shop is known as recognition priming or pattern matching. Our brains are powerful pattern-matching machines. Once you are consciously taught a new pattern, your brain subconsciously starts scanning the world for it. Before you learned about negative working capital, you might have looked at a company like Costco and just seen a big warehouse store. But now, primed with this new knowledge, you see a different reality. You see customers paying a membership fee up front, a $60 or $120 annual fee collected from millions of people, providing a massive float of cash before they even sell a single product. You see customers paying for their goods at the checkout counter instantly, while Costco, due to its immense buying power, might take 30, 60, or 90 days to pay its suppliers like Procter & Gamble or General Mills. Your brain is now primed to recognize this pattern. You look at a software-as-a-service SaaS company that sells annual subscriptions, and you don't just see a software product. You see a company that gets 12 months of cash upfront for a service it will deliver incrementally over the next year. That deferred revenue on their balance sheet is a float. By learning the underlying structure of these businesses, you prime your recognition engine. You develop a form of investment intuition that is not based on hunches or gut feelings, but on the trained ability to spot a specific, powerful, and profitable financial pattern. You begin to see the invisible structure of capital efficiency all around you. This leads us directly to the applied mental model for hunting these unicorns, the industry litmus test. It's a multi-layered approach to systematically find these businesses. Step 1 is a high-level industry screen. You start by looking for industries that are structurally inclined to have favorable working capital dynamics. Think about businesses with subscription models. Software, streaming services, gyms, publications. Think about businesses that collect money before delivering a service. Consulting firms that require upfront retainers. Event organizers and airlines that sell tickets months in advance. Funeral homes that sell pre-need arrangements. Think about businesses with fast inventory turnover and significant purchasing power. Certain types of retailers like supermarkets and fast food franchises. This initial screen filters the universe of thousands of stocks down to a more manageable hunting ground. Step 2 is to dive deep into the financial statements of the most promising companies within these industries. This is where you apply your cash conversion cycle analysis. You don't just assume a SaaS company has a great model. You verify it with the numbers. You compare the CCC of different companies in the same industry to see who is the most efficient operator. Step 3 is the qualitative overlay, a crucial part of the CEO mindset. Look beyond the numbers for the why. Why are customers willing to pay this company up front? It's usually because of a powerful brand like See's Candies, high switching costs. It's a pain to move your entire company off of a specific software platform, or a network effect. Why are suppliers willing to give this company such favorable payment terms? It's usually due to immense scale and purchasing power, like Costco or Walmart. The combination of a favorable industry structure, superior quantitative metrics, and strong qualitative reasoning is the trifecta that identifies a true capital-efficient unicorn. This methodical process turns the art of stock picking into a science of business model analysis. The antithesis to this disciplined hunt is the path of the 99%, which is characterized by chasing fads and mistaking capital intensity for a sign of strength. The average investor is drawn to industries that are easy to understand and are currently in the news. Airlines are a classic example. When the economy is booming and people are traveling, airline stocks look attractive. But think about their business model through our new lens. They have to spend billions of dollars on airplanes, a massive capital expenditure. They have huge fixed costs in labor, maintenance, and jet fuel. While they do get paid for tickets in advance, creating a small float, this is dwarfed by the colossal capital investment required to run the business. They are fundamentally capital-intensive. Another example is automobile manufacturing. Building a new electric vehicle is exciting, and the story of disrupting a legacy industry is compelling. But building a car company requires billions upon billions of dollars for factories, robotics, research and development, and sourcing raw materials. The cash is tied up for months in the manufacturing process before a car is ever sold. These businesses are the polar opposite of See's Candies. They are a constant sink for capital. The 99% chase these stories because they are exciting and visible. They see the planes in the sky and the cars on the road, and it feels real and important. They fail to perform the litmus test, confusing a company's cultural relevance with its financial efficiency. This leads them to own a portfolio of businesses that are constantly struggling for cash, a collection of financial boulders that require immense effort to move even an inch. The direct financial connection of finding one of these unicorns is transformative for a portfolio. When you own a business with a negative working capital cycle, its financial statements sing a beautiful song. You will look at the balance sheet and see a line item called deferred revenue or unearned revenue. This is a liability, but it's the best liability in the world. It represents all the cash received from customers for services that have not yet been delivered. It is your float, visible in plain sight. You will look at the cash flow statement and see a metric called free cash flow conversion. This measures how much of the company's reported net income is actually converted into hard cash. For a normal company, this might be 80 or 90%. For a capital-efficient unicorn, this number can be well over 100%. They are generating more cash than their income statement even reports as profit. This gusher of free cash flow is what gives these businesses their incredible value. It means they can fund all their growth initiatives internally without ever needing to borrow money or dilute shareholders. It means they have a surplus of cash to return to you, the owner, through dividends and share buybacks. Finding just one business like this and holding it for a long period can have a greater impact on your wealth creation journey than a dozen trades in mediocre, capital-hungry companies. It's the difference between owning a goose that lays golden eggs and owning a goose that you constantly have to feed. The financial evidence is clear. Capital efficiency is the secret ingredient to extraordinary long-term portfolio growth. To truly cement the wisdom of seeking capital-efficient businesses, we must spend time in the shadows, studying their opposites. We must fully understand the nature of the capital-hungry trap, the seductive allure of growth that becomes a financial black hole, consuming cash faster than it can be generated. Many of the biggest and most spectacular failures in business history were not caused by a lack of good ideas or a failure to attract customers. They were caused by a fundamentally broken business model that required more and more cash to feed the beast of its own expansion. This is the path of the 99% of businesses and the investors who love them, a path that mistakes the roar of a furnace for the hum of an engine. Recognizing the warning signs of this trap is just as important as identifying the signs of a unicorn. It is the defensive strategy that protects your capital, allowing you to survive long enough for your offensive strategy of finding great businesses to work its magic. The foundational anecdote for this lesson is the cautionary tale of Webvan, one of the most infamous flameouts of the dot-com bubble. The idea, on its face, was brilliant and seemed like the future. In the late 1990s, Webvan promised to revolutionize the grocery industry, by allowing customers to order groceries online and have them delivered to their doorstep within a 30-minute window. The market was enormous. Everyone buys groceries. The story was compelling. The convenience of the internet married to a basic human need. Investors went wild. The company raised an astonishing $800 million in venture capital and then another $375 million in its 1999 IPO, reaching a peak market capitalization of over $1.2 billion. But beneath the surface of this incredible hype was a business model that was a perfect storm of capital intensity. To make their vision a reality, Webvan had to build massive, state-of-the-art, highly automated warehouses in every major city they served. Each warehouse cost over $30 million to build. They had to purchase a huge fleet of custom-designed delivery trucks. And crucially, they had to stock those warehouses with a vast amount of perishable inventory, everything from milk and eggs to fresh produce. Their cash conversion cycle was a nightmare. They had to spend immense amounts of cash up front on infrastructure and inventory, and only got paid after the groceries were successfully delivered. For every new city they expanded to, they had to replicate this colossal cash outlay. Growth wasn't just expensive, it was exponentially expensive. Revenue was growing, yes. Customers in the beginning loved the service, but the company was burning through cash at a terrifying rate. Over $500 million in just over a year. In July of 2001, less than 2 years after its celebrated IPO, Webvan declared bankruptcy, wiping out over $1 billion of investor capital. It wasn't a bad idea that killed Webvan. It was a business model that was fundamentally catastrophically capital-hungry. The underlying psychological principle that sucks both executives and investors into these traps is a powerful combination of the sunk cost fallacy and commitment and consistency bias. The sunk cost fallacy is our irrational tendency to continue with a venture or investment simply because we have already invested significant resources, time, money, or effort into it, even if the current evidence suggests it's a losing proposition. Webvan's executives, having already spent hundreds of millions on warehouses, couldn't bring themselves to pivot or slow down. We've already built the infrastructure, they would argue. We just need to get more scale to make it work. Each dollar spent made it psychologically harder to abandon the next. Investors fall into the same trap. After buying a stock that goes down, they often buy more, a behavior known as averaging down, thinking, I've already lost this much, I can't sell now. I just need it to turn around. This is amplified by our desire to remain consistent with our past decisions. Having publicly or privately committed to the belief that a company is a winner, we are reluctant to admit we were wrong. We filter new information, paying more attention to data that confirms our initial thesis, like rising revenue, and ignoring data that contradicts it, like catastrophic cash burn. This creates a dangerous feedback loop, where bad decisions are reinforced by our own psychological wiring. It takes immense discipline and a ruthless commitment to intellectual honesty, hallmarks of a superior CEO mindset, to recognize when a chosen path is a dead end and to change course, no matter how much has already been invested. To protect ourselves from this fate, we need an applied mental model, a quote-quote capital intensity red flag system. This is a checklist you can run through when analyzing any business to gauge whether it's at risk of falling into the capital-hungry trap. Step 1 is to analyze the ratio of capital expenditures to sales, often written as CapEx/sales. You can find CapEx on the cash flow statement. This ratio tells you how many cents of capital the company has to spend on things like factories, machinery, and equipment to generate $1 of sales. A consistently high and, more importantly, rising ratio is a major red flag. It indicates a business where growth is becoming less and not more efficient. Step 2 is to calculate the working capital required per dollar of new sales. Look at the change in working capital on the balance sheet from one year to the next, and compare it to the change in sales. If a company grew sales by $10 million, but in the process, its inventory and receivables increased by $3 million, it means that 30% of its new sales are immediately trapped as dead money. This is a significant drag on cash flow. Step 3 is to scrutinize the company's financing history, which can be found in the Cash Flow Statement's Financing Activities section. Is the company constantly issuing new debt? Are they frequently selling new shares of stock? If a business cannot fund its day-to-day operations and its growth initiatives from its own internally generated cash, it is a clear sign that its business model is unsustainable. A company that has to repeatedly tap the capital markets is not a compounding machine. It's a dependent entity, reliant on the kindness of strangers, bankers, and new investors to survive. This three-part red flag system is your shield against the allure of profitless prosperity. The antithesis here is not just a single bad approach, but a whole cultural mindset, particularly prevalent in the world of venture capital and technology startups over the last 2 decades, the glorification of growth at all costs. This philosophy dictates that the most important thing for a new company is to acquire users and grow revenue as quickly as possible, even if it means losing enormous amounts of money on every transaction. The idea is to achieve escape velocity, capture the market, and then figure out how to make a profit later. This strategy is fueled by vast sums of venture capital, creating a generation of businesses that are fundamentally built to be capital hungry. They subsidize customer acquisition, offering services for free or below cost, burning through cash in a race for market share. While this can sometimes work for businesses with true network effects, it often creates fundamentally unhealthy companies with no clear path to profitability. Retail investors get caught up in the hype. They see the explosive user growth numbers, they read the glowing media coverage, and they buy into the story, completely ignoring the terrifying cash burn rates buried deep in the financial reports. They become exit liquidity for the early-stage venture capitalists, buying into the story just as the unsustainable economics are starting to become apparent. This is the ultimate path of the 99%. Investing in a narrative without ever interrogating the brutal mathematics of cash flow that underpin it. The direct financial connection of owning a capital-intensive business is a story of wealth destruction and shareholder dilution. Let's look at the balance sheet of a company like Webvan or any of its modern equivalents. On the asset side, you will see a bloated property, plant, and equipment (PP&E) account, representing the billions spent on physical infrastructure. You will see high levels of inventory and accounts receivable. On the other side of the ledger, to balance this out, you will see a mountain of long-term debt with its accompanying interest expense that eats away at any potential profits. And most painfully for shareholders, you will see the shareholders' equity section. Here you can track the history of the company's stock issuance. You will see the number of shares outstanding balloon over time as the company repeatedly sells off pieces of itself to raise the cash it needs to survive. Each new share issued makes every existing share worth a smaller percentage of the overall business. This is the opposite of the wealth creation we see in a company like Berkshire Hathaway, which systematically reduces its share count over time through buybacks. A capital-hungry business is a leaky bucket. No matter how much revenue you pour in the top, the cash is constantly leaking out the bottom through CapEx, working capital needs, and interest payments. Owning a stock like this is not an investment in a compounding machine. It's a constant, uphill battle against the forces of economic gravity, a battle that shareholders rarely win. We have journeyed from the discovery of float to the mechanics of the cash conversion cycle. We've learned how to hunt for capital-efficient unicorns and how to spot the red flags of the capital-hungry traps. The final piece of the puzzle is to synthesize this knowledge into a coherent, lifelong strategy for wealth creation. This is where the principle of negative working capital transcends being a mere stock analysis technique and becomes the core of a powerful investment philosophy. It's about understanding how these rare businesses act as relentless compounding engines within a portfolio, generating the free cash flow that fuels true, sustainable, long-term portfolio growth. This final chapter is not just about finding the right businesses. It's about harnessing their economic power over decades to achieve the ultimate goal of financial freedom. It is the culmination of our entire journey, translating a powerful idea into a concrete plan for building a financial fortress. The foundational anecdote for this ultimate stage is not a single transaction, but a long-term observation of how a business with these characteristics can evolve into an untouchable empire. Consider the case of Amazon. While many people associate Amazon with its capital-intensive retail and logistics business, the true engine of its value creation lies in the parts of its business that exhibit negative working capital characteristics. Think about Amazon Prime. Millions of members pay an annual fee up front, giving Amazon a multi-billion-dollar float to use for a full year before the full value of the free shipping and other services is delivered. Even more powerfully, consider Amazon Web Services, AWS, its cloud computing division. AWS is the modern-day equivalent of an insurance company's float. Businesses around the world essentially rent computing power from Amazon. Many of them pay as they go, but larger contracts often involve upfront payments and commitments. More importantly, the capital efficiency of the business is staggering. Once the initial data centers are built, the incremental cost of providing a bit more storage or processing power is incredibly low. This has created a tidal wave of free cash flow, a torrent of money so vast that it has funded nearly all of Amazon's other ambitious and often initially unprofitable ventures. From building out its massive delivery network to developing Alexa, the cash generated by the capital-efficient parts of the business, AWS Prime subscriptions, and the marketplace where they get paid by customers before paying third-party sellers, created a war chest. This cash wasn't just returned to shareholders, it was used as a weapon for relentless capital allocation. It was reinvested to build an impenetrable competitive moat, making it nearly impossible for anyone to compete. This is the ultimate expression of the compounding engine, a business whose core operations generate so much surplus cash that it can continuously reinvest in its own dominance, creating a virtuous cycle of growth and ever-widening moats. The psychological principle required to execute this long-term strategy is the mastery of delayed gratification combined with second-order thinking. Delayed gratification is the ability to resist the temptation of an immediate reward in order to receive a more substantial reward later. In investing, this means resisting the urge to sell a stock just because it has gone up 20% or 30%. It means having the patience to hold a true compounding machine for 10, 20, or even 30 years to allow the magic of its internal economics to work on a grand scale. This is incredibly difficult for the human brain, which is wired for short-term results. Second-order thinking is the ability to think beyond the immediate consequences of a decision and to consider the longer-term effects. A first-order thinker sees a company generating a lot of cash and says, "Great, they should pay a big dividend now." A second-order thinker sees the same cash generation and asks, "What is the highest and best use of this capital? Can management reinvest it back into the business at a rate of return that is higher than what I could achieve on my own? If so, I would rather they keep the cash and compound it for me." This is the core of the value investing philosophy championed by Buffett. It's not just about finding a good business. It's about partnering with excellent management that knows how to allocate the capital that business produces. This long-term, patient, and strategic mindset is what separates investors who achieve mediocre returns from those who build truly generational wealth. This leads to our final applied mental model, the portfolio compounding strategy. This is the blueprint for putting it all together. Step 1 is active allocation. You must consciously decide to make capital-efficient, negative working capital businesses a cornerstone of your portfolio. This isn't something you stumble into, it's a deliberate choice. You actively screen for these companies, and when you find them at reasonable prices, you allocate a significant portion of your capital to them. Step 2 is management analysis, with a focus on capital allocation. Once you own a piece of one of these cash-gushing businesses, your job shifts from analyst to partner. You must rigorously evaluate the decisions that management makes with the free cash flow. Are they reinvesting it into projects that widen the company's moat and generate high returns on capital? Are they making smart, disciplined acquisitions? Or are they engaging in diversification, buying unrelated businesses they don't understand? Are they buying back their own company's shares at prices that are clearly below their intrinsic value? This is the ultimate test of a great CEO, and as a shareholder, you must grade them on it every year. Step 3 is the commitment to a long-term holding period. The true power of these businesses is not realized in a single quarter or year. It is unleashed over decades. The internal compounding of a capital-efficient business is like a snowball rolling down a very long hill. Your job is to find a good snowball at the top of the hill and have the patience to let it roll. By selling too early, you interrupt the most powerful force in the financial universe, compound interest. The antithesis of this patient long-term strategy is the trader's mindset, which afflicts the vast majority of market participants. The trader is focused on the next 3 months, not the next 30 years. Their world is one of stock charts, price momentum, and trying to predict the market's unpredictable whims. They see a stock go up 20%, and their immediate instinct is to lock in the profit. They capture a small, satisfying gain, but in doing so, they forfeit the potential for a 10,000% gain that comes from holding a truly magical business over a lifetime. They are constantly jumping from one idea to the next, incurring trading costs and taxes, and most importantly, never allowing any of their ideas to fully mature and compound. They are like a gardener who plants a seed and then digs it up every week to see if it's growing. The trader's mindset is a frantic, exhausting, and ultimately less profitable game. They are picking up pennies of short-term profit in front of the steamroller of missed long-term compounding. They are so focused on the wiggles of the stock price that they never truly appreciate the power of the underlying business engine they supposedly own. The direct financial connection of adopting this long-term compounding strategy is the ultimate prize. Imagine 2 portfolios, each starting with $100,000. Portfolio A is invested in a basket of well-known, capital-intensive businesses, an airline, a car manufacturer, and a heavy industrial company. These companies might grow their revenues, but they must constantly reinvest a huge portion of their profits back into the business just to maintain their competitive position. They have high capex, long cash conversion cycles, and may need to issue debt or equity to fund major projects. Portfolio B is invested in a basket of capital-light, negative working capital businesses, a dominant SaaS company, a powerful consumer brand with pricing power, and a business with a strong subscription model. These companies also grow their revenues, but their growth requires very little additional capital. They gush free cash flow. Over 20 or 30 years, the difference in outcomes would not be linear. It would be exponential. Portfolio A might grow to $300,000 or $400,000, a respectable return. But Portfolio B, fueled by the relentless internal compounding of its holdings, the reinvestment of free cash flow at high rates of return, and the lack of shareholder dilution, could grow to several $1 million. The final numbers are almost incomprehensible at the start. This is the tangible, life-altering financial advantage we have been seeking. It is the direct result of understanding one single principle: find the magical businesses that grow without needing any cash, and then have the wisdom and patience to let them work their magic for you. You have just spent your valuable time absorbing a framework that fundamentally changes the way you look at the world of business and investing. This is not a hot stock tip that expires next week. It is a permanent upgrade to your mental software, a lens that, once acquired, can never be lost. You now possess the ability to look at any company and diagnose the health of its cash engine, to separate the capital-efficient unicorns from the capital-hungry beasts. You have learned to see the invisible flow of money that determines the fate of all enterprises, a skill that the vast majority of market participants will never acquire. You have invested in yourself, and that knowledge is now an asset that will pay dividends for the rest of your life. But understanding this one powerful principle of negative working capital is like mastering a single, devastatingly effective punch. It makes you formidable, but it does not make you a complete martial artist. Warren Buffett's system of identifying wonderful businesses is not a single punch. It is a complete fighting style, a latticework of interconnected mental models. The principle of capital efficiency is one crucial pillar, but it is supported by others. The concept of an impenetrable competitive moat, the psychology of pricing power, the dynamics of network effects, and the critical importance of trustworthy management. Each model strengthens the others. A business with negative working capital becomes infinitely more powerful when it also possesses a beloved brand that gives it pricing power. The journey to true financial mastery is the process of building out that complete latticework in your own mind. The video that is now appearing on your screen is not a random suggestion, it is the next piece of the map. It is the component that links the concept of capital efficiency to the source of a company's competitive dominance. It is the lesson that will take the powerful tool you have just acquired and connect it to the broader system, making both exponentially more effective. The path of an amateur is to find one good idea and cling to it. The path of the master is to assemble a full arsenal of mental tools, a complete system for understanding the world. The choice to click is not a choice to watch another video. It is a declaration. It is the choice to continue your ascent, to build out your mental arsenal, and to complete the transformation from a mere investor into a true student of the game. Continue the journey,